All right. Happy Monday to you. You have Wednesday off. A couple of things just to check and make sure I didn't miss you when you came in. No Haven yet? Noah Dare. Erwin, you're here. Jacob Ramirez. Isaiah R. Lupe. No Matt. Yasmin. Braden. Daniela. Julio. Okay, so a couple of things. Last week we took a look at Module 11 and Module 12, demand and supply. Today we're going to put those things together and show how both households and firms operate in our economic system. We'll also cover what is a mutual fund. If you saw the news this morning, Pfizer, along with I think biotech, have a vaccine they say is 90% effective. So Pfizer, biotech, those stocks are up amazingly high. We'll talk about what other news like that affects stocks. Obviously, there are also negative effects, right? Zoom is down 18% on this news, right? Because if there's a vaccine, people will start meeting in person and going back to work. So we'll talk about equilibrium and show what happens in our market when both supply and demand are evaluated. We'll go over the 2 assignments that you'll need to complete and show you how to access your assessment. So go ahead and log into your Canvas page, Module 13. Okay, so a couple of things. When we talk about equilibrium, as I said, we're going to understand sort of how supply and demand come together. So we want to understand how households and firms and their interaction in terms of households' demand to firms' supply will affect various things in the economy. And we'll show what equilibrium is, what that means for you, and how the economy would act with those items. So a couple of things. First, when we talk about equilibrium, we use the circular flow model template sort of as a guide, right? We talked about households as consumers, firms as producers, and we have exchanges that go back and forth between the two. That is what sets us up for putting supply and demand together. So when we look at, let me zoom out of this a little bit. There we go. When we look at both of those together, so this is from the point of view of households in terms of demand, point of view from firms, businesses in terms of supply, we want to explain equilibrium between demand and supply. You need to be able to graph that equilibrium point along with price and quantity, and then describe how price acts as a rationing device, something that holds up. So simply, equilibrium price is the price at which the quantity demanded equals the quantity supplied. They're exactly the same. There's only going to be one point on a market curve that shows that. So now instead of a demand curve or a supply curve, we have what's called a market curve. It's going to keep everything together. The equilibrium quantity is the quantity at which supply and demand are together. All right, supply and demand are together, equal. So equilibrium can be found where the demand curve and the supply curve intersect. That price point is equilibrium. Now, when we talk about rationing, rationing is the condition in which the quantity demanded is greater than the quantity supplied at a certain price. If we're in a surplus situation in terms of rationing, this is the condition in which the quantity supplied is greater than the quantity demanded. So we can have a shortage or a surplus situation in these rationing scenarios. Changes in demand and supply. We talked about things that can change demand, right? Income, attitude, substitute products available, complementary products available. So what we're going to look at, let me bring this up so you can see this in terms of what we have. Exit out of this. Let me bring it up to here. Okay. So share that. Okay. So here is a market schedule. So we no longer have a demand schedule and a supply schedule. We have a market schedule. We still have our price and quantity demanded points, and we've seen those before in each of the last two modules, right? Price and quantity demanded. So there's a price and quantity demanded point for each, but we also have, right, price and quantity supplied points. And so you can see the law of demand and law of supply is going to follow this in a market schedule. You can see that as the price goes up, the quantity demanded goes down, but the quantity supplied is going up. And so you can see what we have in a market schedule. Now, when we look at this, the equilibrium price is going to be where quantity demanded is equal to quantity supplied. So in this market situation, at $3.60 per unit, there are 2,000 units demanded, there are 2,000 units supplied. So our equilibrium price is $3.60, our equilibrium quantity is 2,000. So equilibrium is simply when we put supply and demand together, where are those equal to each other, right? When we look at a market curve, all this is the price and quantity supplied points, price and quantity demanded points put onto a curve. So again, here we have supply, right? Which we would basically label as S, that's our supply curve. This is our demand curve. You see they both still follow the law of demand and law of supply. And then what you have here is equilibrium. Equilibrium is the one point where supply and demand intersect each other, and that gives you equilibrium price, equilibrium quantity, right? Equilibrium price, equilibrium quantity. That's what we're examining this unit. All right, back to this. All right. So let me get to this page here. All right. So a couple of things can happen, right? What happens to equilibrium if demand increases, right? Demand curve is sloping down from left to right. An increase is a movement away from zero. It would move the demand curve to the right. If you have, okay, an increase in demand, consumers are willing to buy more at each price than they would have before the rise in demand. Result is if supply stays the same, prices are going to rise, quantity exchanges rise, because that's your curve moving to the left. What happens to equilibrium if demand decreases? Decrease in demand means that consumers are willing to buy fewer units at each price. If supply stays the same, prices fall, quantity exchange falls. And I'll show you in a picture graphically what this means. If you take equilibrium and want to know what happens when supply increases, an increase in supply means that producers are willing to supply more at each price. This is your supply curve that slopes down from right to left instead of left to right. So if demand stays the same, prices fall, but quantity exchanges rise. What happens to equilibrium? Supply decreases. Decrease in supply, we know, means that producers are willing to supply less at each price. Prices are going to go up. Quantity exchange is less. So you know this from simple demand, especially during the holiday season, right? Something becomes very, very popular. If supply decreases at this time, things become very popular, the price goes up. So what you need to do is be able to understand what happens if we have a change in demand or supply, what happens to equilibrium. Now also we have instances, and let me show you, we've talked about this before. So let me get to your change. So I want to show you this graphically. Oops, I'm going to share first. Okay, so all we said there through a bunch of those words basically is what happens if one, either demand or supply stays the same, but we have an increase or decrease here. And so it's very, very simple. It's probably a lot easier to see when it is a picture than words, but this is our original demand here, right? Our original demand would probably be labeled as a demand curve D, okay? We would probably name this D. The new demand, if we have an increase in demand, supply stays the same, would be labeled D1. And then you can see the arrows here, right? Demand increase means that the curve is going to shift to the right because it's farther away from zero. You can see what happens to the equilibrium price. If supply stays the same and demand increases, the curve moves to the right. That increases our equilibrium price, and it also increases our equilibrium quantity. All right, that's all this is showing what we just went over in words. And that's a graphic representation. If you take a look at, right, demand decreasing, if this were original demand and we had demand decrease, decrease means closer to zero, right? You're going to have a lower equilibrium price and a lower equilibrium quantity. That's all those notes were saying. Now, if we talk about supply, demand stays the same. We have new supply. Your original supply is S. Your new supply is S1. If we have an increase in supply and demand stays the same, that means the supply curve moved farther away from zero. You can see here, though, equilibrium goes from, right, 360 down to 350, which makes sense, right? Demand stays the same. supply increases. If the supply increases, you're going to have more of your equilibrium quantity. But if you put a bunch out on the market, it's going to drive the price down. Going to drive the price down. So you take the last example, your original supply curve would be S, your new supply curve would be S1. This is closer to 0. You can see that equilibrium price goes from 360 to 370, but your equilibrium quantity goes down. And that makes sense, right? Demand stays the same, supply goes down, so does your quantity supplied. So that's why you have curves and movements to the left. All right, so lastly, talk about how government can interfere in the market or manipulate the market. So a couple of things here. When we look at, when we look at equilibrium, there are things called price floors and price ceilings. And the government can intervene in the market system to stop a balance between supply and demand. So sometimes the government intervenes with the market system to block a balance between quantity demand and the quantity supplied. So examples, the government may allow only a certain amount of imported steel to enter the economy. This was, Trump's tariffs on imported steel. This cuts down on supply and thus results in a higher price for American manufacturers of steel. The government may buy grain products. This increases demand and thus results in a higher price. So we, throughout a couple of different administrations, even George Bush's administration in the early 2000s, we would buy grain and send it to Africa for countries that were suffering from famine. Buying up the grain basically makes the supply smaller, increases the price. Not only are we being humanitarian in terms of helping a different continent who's going through starvation, but we're also helping our farmers in raising the price of their product, thus increasing their profits, right? Because remember, again, total revenue minus operating costs gives you your profit. The government may set rent controls to keep apartment rents below the market level. This hurts businesses but helps consumers. The government sets minimum wages to keep them higher than they might normally be, right? So the government, again, setting a minimum wage for people that may be in a industry that would not support such a thing. So a price floor is a minimum price set by the government that is above market equilibrium. Price ceiling is a maximum price set by the government that is below market equilibrium. And so a couple of things about this. Let me get to the proper spot because that almost sounds backwards, but we'll show it to you in this sense. Graphically, it'll make more sense this way. All right, so a couple of things. When you look at a market curve, there are a couple of different things that you want to see. There is a force of price that goes to equilibrium. There's a force of price that goes to equilibrium. Under normal circumstances in a market, whether it be the United States, anywhere else, consumers, households, firms and businesses, right? The supply side of the economy, if the market were allowed to interact, generally the force between households and firms would force most of the movement in the economy towards equilibrium, right? Businesses and firms aren't going to make more than they can sell. People aren't going to buy more than they could use. So as the market allows, we'll have the force of price going towards equilibrium. So when we talk about a price floor and a price ceiling, what we're talking about is two artificial barriers set by the government that stop the force of price. And so when we look at this, a price floor is always going to be above equilibrium because it stops the force of price from moving down, right? Price ceiling is always going to be below market equilibrium because it is going to stop the force of price from going up. So usually ceilings are on top, floors are on bottom, but all this is doing is stopping the force of price, stopping the force of price. So a couple examples of that. All right, when we look at this, right? So we've got a price floor at $4. This prevents the market from balancing the quantity demand and the quantity supplied at 360. A surplus results, consumers pay a higher price and they buy less. So if, and this is bushels per wheat, right? This is bushels, price per bushel for wheat. $4 a bushel. If the government sets a price floor, that's the minimum price that's accepted. What happens is that you have a higher price than you normally would. And then if you look at those two price points, right, there would be 2,200 bushels supplied. Consumers at that higher price point would only buy 1,800 million bushels. You're going to have a shortage situation, right, where supply is more than demand. Now, if the government sets a price ceiling, you can see here, right, that it's reversed. Price ceiling, right, you cannot charge more. This is the maximum amount that you can charge, right? If they can only charge $3.20 a bushel of wheat, there is going to be a shortage of wheat, right? Because it's below what the market normally would be, which is right here. If it's 40 cents a bushel below, all the wheat is going to be bought up and then you're going to be in a shortage situation. So price floors and price ceilings are going to be very controversial, just like Trump's tariffs on imported steel were, because of how it might affect, all right, various groups, how it might affect various groups. All right, so on your next page, all right, so the first page there had those slides, basically, for all of the notes that you need, right? The next page has a quick review on when you put supply and demand together. So that reviews module 11 and 12, all right? We talk about the role of prices because the role of prices is going to be the biggest determining factor in the market. So prices in our free market system play the biggest role in our economic system. They act as an incentive, right? Things go on sale and it incentivizes people to buy. It acts as a signal, allows us what's going on in the market, provides flexibility because generally prices can be changed quickly to match circumstances, right? When the pandemic hit and there were lockdowns, right? You saw airline tickets respond by slashing airline ticket prices throughout the world. Pricing system in a market system is free. It doesn't cost anything for us to operate our system like this. We generally have a wide choice of goods available to us and allows for efficiency in allocating resources. Now, the disadvantages of a system based on price is that there's a supply shock, and that's a sudden shortage. So when something comes out, say this vaccine comes out, there's 375 million plus Americans. Will they have enough of the vaccine for 2 doses that are supposed to be taken with it, right? Could be a supply shock based on that. We also have rationing, dividing up a good or service without regard to price. So with the vaccine example, you may see that they will ration the vaccine, give it first to doctors and nurses who work in the healthcare industry. So they will hold some of the vaccine back to make sure police officers, fire personnel are given that first. Probably higher level people in the government would be given that vaccine first. You also have a disadvantage because prices lead to a black market, right? Goods that are rationed or illegal, you'll see in the black market. You also have imperfect competition. The government just recently sued Google and is going to take them to trial on a monopoly in terms of how they run their search engine. And you also have spillover costs, things that are unforeseen to the cost of production. The next video you have talks about markets, efficiency, and price signals, how all of these things will work together, how all of these things will work together. All right, so let's go to the last page in your module is what is a mutual fund. This will be the last of the 3 types of investments that we need to see. So I'll show you this short video. And then we'll make our trades. I'll show you what you have to do for finish for the week. We'll be set. Line this up. There we go.
A mutual fund is a collective investment that pulls together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. When you purchase a share in a mutual fund, you have a small stake of all investments included in that fund. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund. Mutual funds can potentially benefit investors in several ways. They are a way to make a diversified investment. Most are managed by financial professionals, and because of the wide variety of mutual funds, they allow investors to participate in a wide variety of investment types. Let's walk through an example of how a mutual fund works. Suppose there's an investor who wants to invest some of his retirement portfolio in the stock market, but he doesn't have time to analyze individual stocks and create a diversified stock portfolio. Instead, he decides that he'd rather purchase a mutual fund. This way, the investor can purchase a single investment, which will be similar to purchasing an entire portfolio of stocks. But which mutual fund is right for him? To find the right one, he uses online tools such as mutual fund searches and ratings given by independent third-party organizations to find a mutual fund that meets his investing goals. Once he finds a fund that looks like a good fit, he reviews the fund's prospectus, which is the official summary and explanation of how the fund operates. The prospectus provides a variety of information about the fund, including its fees and charges, minimum investment amounts, performance history, risks, and other useful information. After researching the fund and its prospectus, our investor decides that this fund looks like a good investment. So he buys the minimum required investment amount and purchases shares of the mutual fund. By owning shares, the investor now participates in the gains and losses of all companies held in the fund. A benefit of this is diversification, which is when an investment or portfolio is spread across several different investments. Doing this can help lower risk. For example, if one company that the fund invests in has a rough year, the impact on the fund's total assets can be small, because that struggling company is only one fraction of the fund's total assets. Like most other mutual funds, the fund the investor chose is actively managed, meaning it is run by a fund manager or managers who buy and sell the fund's assets. Fund managers aim to provide the biggest returns they can for investors by using financial analysis and professional expertise. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, our investor won't earn the returns he was hoping for. However, even if the fund doesn't perform well, the manager still earns a fee, which is paid from fund assets, meaning even lower returns. Management fees are the only costs our investor has to pay. Besides
Okay. So a couple of things as it relates to your stock market competition. I believe this is going to be week 4. And so let me share my screen with you. If you take a look at period 1, all right, right now in terms of what you have, group 4, by the looks of it, you're up $214 at the end of last week. Group 5, you're in second place during this period. And group 6, you are in third. So a couple of things that you want to check every week and make sure that you stay on top of. Let me reset this so it shows. Is when you go to portfolio and go to account holdings, you can see how much you have in cash, how much you have in stocks, how much you have in bonds. Today we'll do the third in terms of mutual funds. So here you can see all of my positions. Some are easing up, some are down a bit. Harley Davidson is killing me, so I need to dump that. One of the things that you'll see, and I mentioned this at the beginning of class, is that when you go to any site, so I'm going to go to finance.yahoo.com, same thing that we've done before, you'll see what the market has done with reaction to this upbeat vaccine data, all right? So Pfizer and BioNTech, right, have increased in value because of the 90% efficiency rate of the vaccine. It has also affected airline industries. Southwest Airlines, American Airlines up. The cruise ship industry, which had been shut down completely basically since March, right, is up $4.74 a share. Pfizer's up $3.38. There are a number of companies, right, in which that's good news. The one negative, the biggest negative that I've found today is Zoom. Zoom is down a good portion here, $65.71 a share, 13% of its value, right? Because if people are meeting in person, you won't have as many people needing that software to meet virtually anymore. So when good or bad news happens, it can be a positive or negative effect for many of the companies that you might be trading. So you want to make sure that you keep up with that. Now, down the right-hand side, in the finance page, there's a block that's called Top Mutual Funds. And let's see if I can reload this page because it's not allowing me to see anything. Okay. So again, let me reset this so you can see it. Because you're going to make your third type of trade today, which is going to be mutual funds. Let me share this with you. So down the right-hand side, as I said, there is a category called Top Mutual Funds. And basically what it does is it loads results of mutual funds. You can see how much the change has been, what the price started at, 50-day average, 200-day average, 3-month return, year-to-date return, right? So this Trans-America Capital Growth Fund right now is year-to-date return of 74%. So if you take that symbol, ILLLX, you could make that trade in your stock portfolio. Mutual fund trade, buy ILLX. That was selling at, let me see what it was selling at. Selling at around $38 a share. So $38 a share, I'm gonna buy probably 50 shares maybe. See if I can get to the right page. So I'm gonna buy 50 shares of that. All right, it tells me that it is the wrong type of mutual fund. So you can go to search. See if it'll let you load up data. It's saying not secure again. Well, mine's not. Let me see if it'll allow it. Ugh. There we go. I had a space. 50 shares. It's up to $39.47, so it's already almost got up $1 just today. And then you can put in your password. Okay. Confirm that trade. Once you do that, okay, if you go to transaction notes, right, in terms of that, you can see here, these are everything that have been executed. Notice that the bonds that we did on here in class last week are there. Mutual fund trade is going to be under pending orders, just like a bond trade. So you can also go to here and let's see, year-to-date return, First-Hand Technology. Morgan Stanley is highly respected, so that's MIGPX. So I'm going to make a second mutual fund trade. Make sure you click buy, MIGPX. I'm going to buy 50 shares of that as well. Preview that trade. Confirm the trade. You can go to pending orders and see that it's there. Order was accepted. All right, so you are going to trade 2 mutual funds. As I said, the best way to do that is if you go to finance.yahoo.com, you can go /mutual funds if you don't want to scroll down the right-hand side. But this will give you lists and lists of mutual funds, right? Basically over 1,400 mutual funds. Voya in real life is who I have my mutual fund with. And so you could, if you wanted to, you could go to and type in, say, Voya Mutual Funds and see what they have to offer, right? So you could go to Voya Mutual Funds and bring that up and see what they have. So that would be one way to look at that, or you can do these top results. It's totally up to you in terms of how you do that. So I will put you in your groups. Check here. 9. Okay, so it's here. Alex is here. And Erwin is here. Group 2. Okay, so in your breakout room, you're going to buy 2 different types of mutual funds and add that to your portfolio. I'm still showing no trades. You got about 4 minutes left to make both of them.
Yeah.
In a group.
You're on mute, Mr. Grok.
You guys are group 5? Is that right?
I think so.
Yeah. Okay. So you guys need to make 2 mutual fund trades right now. You got about 3 minutes left.
Okay.
All right.
Okay, you guys got about 4 minutes left, and I don't see any trades yet.
Well, I thought I posted 2. Okay.
Let me check. I haven't updated it recently. Perfect. Yours say insufficient. You bought too many.
Oh,
So you got to redo them.
all right.
Yeah. So try maybe 10 shares instead of 25 and 50.
Did it work now?
No, I was just going to try to join you. It said that you did not have
Enough shares or whatever.
yeah, said insufficient funds. I'm going to have you share your screen real quick.
Oh, I remember the problem last time because I'm on an Apple thing when like the security problem.
Okay, yeah.
Did I do less shares then? Like 5?
I don't know why let me read about mutual funds real quick. Maybe you have to do more than some. But
You're
I
supposed to sell them, right?
you did click buy, right?
Oh, I think I clicked sell. Maybe that's my problem. Okay, yeah, I'll fix
Click-
that.
Actually, you know what? I can check what you clicked. Hold on. I think I can go back and check. Yeah, you might have clicked sell. That might be it. Okay, so everybody's back. Couple of groups had completed only one trade. So group 5, you're still missing your second trade. And group 4, you're still missing a second trade. So you need to make sure that you get that done. Lastly, real quick, in terms of what you have, let me bring this up. Okay, so this is module 13, week 13. All right, we went through equilibrium, reviewed the role of prices in terms of setting a price floor or price ceiling. Remember, a price floor is going to be above equilibrium because it stops the force of price from going towards equilibrium, which would be down. Price ceiling is below equilibrium because it stops the force of price from going up. You have 2 case studies on supply and demand. The first one, all right, is about your uncle's barbecue restaurant is struggling, fewer customers, he's looking to make some changes to the menu. He heard that you've been studying economics, he wants your advice, you research popular food trends, all right? The second case study, putting demand and supply together. Congratulations, you're getting married, right? You've decided to go to Fiji or Hawaii on your honeymoon, and while looking up the cost of flights, you come across this, right? So you'll do both of those and then submit that. There is a review for the equilibrium assessment, and then the equilibrium assessment is test number 6, all right, is test number 6. So on that test, it'll have your PDF on the left and have your answer sheet there on the right, right? And so you can just fill that in from there. A couple of things to remember. I got a number of questions this weekend about not able to enter in or access their assessments. And let me show you a couple of things here about that. Okay. So let me bring this up. All right. So on this particular assessment, I think this is world history, what have you. It doesn't really matter. They're going to be available 7 days a week, but they are only available during a certain time window. Either 7 a.m. to 9 p.m. or 7 a.m. to 10 p.m. If you try to access the assessment outside of those times, it's not going to be available no matter what I do. All right. So you didn't make sure that you have that set. As I said last week, your module 11 is due today at 3:15. So if you've not finished the items in module 11, the determinants of demand on GoFormative, the demand case study in the basically the Google form, and your test, those will start showing up as missing assignments today. Your 2 mutual funds will start showing up on Friday, but that's what you want to complete. The week 12 module, as I told you, gave you 2 weeks. That'll start showing up in Aries next Monday, the 16th. And then these actually won't start showing up in Aries until the Monday of the Thanksgiving week break, but they are open and available to you. All right. So your group needs to make those 2 trades before Friday. You'll be back on the normal schedule next week. So we'll meet on Wednesday, which will be the last meeting before Thanksgiving. And we will cover types of businesses, business organizations. So proprietorships, partnerships, corporations, LLCs, LLPs. We'll go over all of that in terms of what have you. Make sure that your group makes those trades and have a good week. We'll see you Wednesday.